For months, it just felt unstoppable, right? The AI market rally was this freight train just barreling down the tracks. But then on November 13th, 2025, that train, well, it hit a massive speed bump. So let's get into it. Let's unpack the day the market really started to have second thoughts about AI. And this quote right here from Jackson Ader at KeyBank, it just nails the mood perfectly. AI sentiment is waning. This wasn't some quiet little shift in the background. No, this was a loud, clear message from Wall Street. You could feel a chill in the air for what had been, hands down, the hottest sector in the market. 33%. So what's that about? Well, that is the staggering loss in value for Oracle, a company that had been one of the biggest darlings of the AI market. This was just since its peak 2 months before. A third of its value just gone. And believe me, this wasn't just some isolated thing happening to one company. No, this wasn't just an Oracle problem. November 13th, it was a signal, a reality check for the entire tech market. It really felt like a day of reckoning, forcing investors to finally look past all the hype and get back to the fundamentals. And you can see that reality check so clearly right here. Look, the Dow Jones, which represents the broader market, yeah, it took a hit. But the tech-heavy NASDAQ, it absolutely tumbled. This tells us something really important. This wasn't a market-wide panic. This was a tech-centric sell-off. And the numbers don't lie, a 2.29% drop. That made it the worst single day for tech stocks in over a month. And it wasn't a fluke. It was the end of a 3-day losing streak, which really confirmed that investor confidence was seriously shaken. So, where was the epicenter of this whole earthquake? Well, let's zoom in on one company in particular. And that brings us right back to Oracle. I mean, how does a company go from being a Wall Street hero to the poster child for AI excess in just a couple of weeks? It's kind of wild. The timeline of events really tells the whole story. And what a dizzying ride it was. Seriously, look at this. In September, Oracle is on top of the world, hitting a record high thanks to this amazing forecast. Fast forward to October, you've still got buzz at their big conference, but you're starting to hear these little whispers of doubt. And then, bam, November hits and the stock is in an absolute freefall. So, what lit the fuse on that rocket ship in the first place? It was this, just mind-boggling number, a $300 billion 5-year commitment from OpenAI to use Oracle's cloud. I mean, can you imagine? That single deal just captured everyone's imagination and sent the stock soaring. But here's the thing about big promises. They need a really strong financial foundation. And to really get what's going on here, we have to talk about something called free cash flow. Don't worry, it's pretty simple. It's basically the real cash a company has left over after it pays all its bills and reinvests in the business. Think of it as a key indicator of financial health. Now, keep that definition in your back pocket because it's super important for what's coming next. Okay, so here's the crucial part. When analysts started looking under the hood at Oracle, they saw a big problem. You compare them to the cloud giants, Microsoft, Amazon, Google, who are just swimming in cash, right? Well, Oracle was expected to generate the least amount of free cash flow. They were spending like crazy, but didn't have that same financial cushion. And some analysts, they did not mince words. Gil Luria from D.A. Davidson straight up called Oracle's strategy bad behavior in the AI buildout. I mean, wow. That quote just perfectly sums up the growing concern that Oracle was taking on these huge risks, this massive debt, all based on the promise from one single customer, which, leads to the billion-dollar question. So was this all just about Oracle's huge, aggressive gamble? Or was it a sign that maybe, just maybe, the entire AI party was starting to wind down? Well, investors started looking a lot closer at the details. And what they found were some pretty serious cracks in the story. First off, Oracle was taking on a mountain of debt. Second, they were almost completely reliant on a single cash-burning startup, OpenAI. On top of that, the profit margins on renting out these super important GPUs? Surprisingly thin. And maybe the biggest red flag of all, people were starting to have serious doubts about whether OpenAI could even afford to pay that massive bill. And speaking of that mountain of debt, check out this number. $38 billion. That's how much new debt Oracle was reportedly trying to raise, just to fund its AI infrastructure. It was a massive bet that was suddenly starting to look incredibly risky to the market. So if the smart money was getting nervous about AI, where was it going?
Well, that led to this whole counter narrative, right? As tech started to falter, a rotation began. Investors started looking for new opportunities, and they were looking far, far away from the AI data center gold rush.
And you know who captured this pivot perfectly? Jim Cramer over at CNBC. He said, increasingly, I feel like there are better places to hunt for winners than the AI space. He basically saw this super narrow focus on AI as dangerous and was telling everyone, hey, it's time to look somewhere else. It was a call to diversify away from that really crowded tech trade.
So, where were these better places to hunt? Well, Kramer pointed to a whole bunch of non-tech sectors. We're talking about retail, think Costco and Macy's, travel, United, Expedia, Marriott, even restaurants like Chipotle and Texas Roadhouse, not to mention aerospace and pharmaceuticals. These were all established, maybe even undervalued companies in the real economy that were suddenly looking pretty attractive.
And this right here might be the most important takeaway from that whole day. The fact that the Dow could be hitting records at the same time the tech-heavy NASDAQ was sinking, that showed that the entire foundation of the market was potentially shifting. Leadership was broadening out, moving beyond just a handful of giant tech companies.
And so, that leaves us with the big question, doesn't it? Was November 13th, 2025 just a temporary correction? You know, a momentary panic attack in what's still a long-term AI boom? Or was it the beginning of the next great market rotation? The first real tremor of a massive shift out of tech and into everything else? Now that is something for all of us to watch.